Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Today is first notice date for all December expiry contracts. And what we find today is after having had a very nice run to the upside for the December corn contract, yesterday it posted quite a big loss, surrendering all the gains from the previous 7 to 8 trading days. Today the market comes back in and we see it basically holding up right up against support at 337. And here is the 50% range of this previous move that we had talked about before, being a very important area. If this market is not able to hold this 337 area, we would look for potential support either at 331 and 3/4 or even coming down as low as 324 and 1/4. But for now, we anticipate that as the market is coming off the board, that it should hold support perhaps near the 331 and 3/4 area over the next coming days. The high that came in 2 days ago was a direct hit for volatility-based resistance. It also hits the 45-degree angle at 362.5, and so it's not surprising that as the market was making its way up and reaching being overbought, although it didn't quite get there, that we would find some weakness coming in. We do believe that we have support coming in around 343 and 3/4 for this contract. If it's able to get below that 334 and 3/4 area, we anticipate that 334.5 is about as low as this contract will go, only because we have several areas of support coming in, showing that the market here has decent support near that area. The March corn contract is looking to find support potentially at 341 and 3/4. If it's not able to hold this 347 area, which it looks like it will probably break given the nature of the strength of the recent decline yesterday, we're looking for support to come in either near 342 or possibly near 336. This is where this March contract will perhaps find a low before possibly being able to find its way back up again. From this view, we can see how volatility-based resistance played a very key role in forecasting for us potential resistance. We also have our sinusoidal wave that came in conjunction with that same area. And so as the market came in and touched that zone, there was the resistance that came in, and from that point forward, the market has now been declining over the last 2 trading days. Just below, we have support coming in potentially at 1018, and below there, if the market does break, then we're looking at 986 and 3/4 for 2 very good potential support areas. Coming off of support when it was initially at the 986 and 3/4 area, the market moved up 180 degrees, found resistance, and so here we would anticipate that the market would either move down about 90 degrees or perhaps retest that previous level before being able to turn back up again. Last week, we talked about the potential for a time factor high coming in. Here we can see the intersection of several of our trend lines, along with the dotted line that we had highlighted for you last week. With that, the market actually does in fact move up into resistance in conjunction with that time projection and has now been moving down from there. And so we like very much the movement that we're seeing and how the market has been consistent. We also see kind of a mirrored move. If you look at the distance that the market moved here, it's the exact same distance that we're seeing here. And so it would not come as a surprise for the market to make about a 4 to 5 day pullback, repeat the exact same thing again, and perhaps coming into about mid to early December, and then coming back up again from there. On this chart, we can see how several factors came in to give us our top. First of all, we have the same time factor that we had addressed before, telling us that the market was due for potential correction time-wise. We also had several intersection points of trend lines coming in, and to boot, we also had resistance overhead at both the volatility-based resistance as well as the actual trend line just above. So the market came in right inside this area and had very good resistance here after having made a reasonable pullback and then turning back up again. So from here, we would look for the market to perhaps trace down one of our trend lines. Depending on how strong the downtrend would be, it could move along this trend line or this trend line, and where we have a time factor coming in for a major change in trend later in the month of December. But again, as we can see from the market here, we were due for a potential top or potential correction. It does not negate the capacity for this market to actually turn back up again, but the huge supply that we're seeing in the absence of demand can make it a little bit difficult for soybean to gain some ground, although cycles continue to tell us that the market does want to turn to the upside. December wheat really struggled once it got to about 412 to 413. We had a 180-degree mark at that number, as well as a 38% retracement from the previous range. Looking at the market now, we can see that after it hit resistance, the market has actually been down significantly. Today, it was up a little bit, but has since given up much of those gains. And even though it's oversold right now, given the nature of the weakness that we're seeing, the possibility of it running down to about 373 is not outside of the realm of possibilities. For now, we'll just continue to trace the wheat contract and move on to the next forward contract, given that we are sitting on first notice date. In fact, much of the volume has already begun to leave this contract, so the next contract is where we really want to see our analysis. The March wheat contract tells us quite a bit. We can see how current support, or at least what had been current support for quite some time, finally broke over the last 2 days. It was tested previously a couple weeks ago, and now it's finally really broken, and we had two key levels of 409 and 402 that we were looking at for potential support. You'll also notice that previous support was actually holding very well near 429.5. The market came in, it broke it for a little bit, came back down, retested here, and we almost have a bit of a head and shoulders formation where we're finding some good weakness here. Going forward then, given the nature of the weakness of what we're seeing, below 409 and below 402, the market should then come in and find potential support near 350 or so, perhaps or 360. So coming in inside of these areas here is where we're really looking for the market to find true support before really being able to get some legs, given that it's broken key support and has not been able to hold it after what had been a very long consolidation for this contract. Additionally, we have a time factor of about December 19. And as you can see in the past, where we've had the markets come in, we had a very nice time marker here where the market moved up. After the move up, the market then moved down at the end of our time marker. Our next time marker, the market made an advance. It came back in and dropped back down. And so our next important time marker that we're looking at right now is that December 19 timeline. OPEC finally agrees to its first production cut since 2008, and as you can see from the chart, the move today speaks for itself. The news was very well received, and the market jumped up several dollars today, as we can see on the chart. It's also interesting to note that the market, after having made its move off of key support and resistance areas that we've demarcated for you in the past, the market came in right at our synodic cycle line, and where the market came in and made that low also coincided with a 62% retracement, and from there the market was able to rally in a strong fashion. The next thing that we want to bring to your attention is that the market is now well beyond the $50.10 mark. That being the case, and now that it looks like the market will close above this area, we are now looking for the market to exceed previous highs and to continue higher and to perhaps reach somewhere in the neighborhood of $60 before finding true resistance. Overhead, the next key resistance area we're looking at is at $55.74, and above that we'd be looking at about $60. Follow through to the news that was received today is going to be key. Again, we'll be looking at key resistance at $55.73, and right now overhead at $51.99, or essentially at $52. It looks like the market's not going to have much of an issue getting through there. Once it gets to the previous high, that's going to be our key area for now, to see whether or not the market does in fact turn down or simply continues higher. We do have a time factor coming in at about December 16th, and so that's going to be an important timeline for this market. And in all likelihood, we're probably looking for the market to continue to climb through that timeline. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.